So welcome everyone to this week's edition of the Commercial Real Estate 101 Meetup Group. For those of you guys who are tuning for the first time, we actually do this every other week where we invite speakers who talk about a variety of different topics pertaining to commercial real estate. And today we have the honor of having Myra Sheene. She's a friend of mine locally, also a financial planner, CPA, really just a rock star in the local area here in Louisville, Kentucky. And we're really excited to kind of dive in to some financial strategies regarding people that are in the commercial real estate space. And so we'll be talking on, people who are in the brokerage space, which I know is a big contingent of our listeners, but we'll also be touching on other verticals within the space as well. So Myra, thanks again for agreeing to do this. We really do appreciate it.
Oh, thank you. It's a privilege to be on here and the opportunity.
Absolutely. And so before we dive in, I want to preface all this discussion by saying this is all informational. Again, everyone has a unique financial standing and unique financial situation. So, don't take this as individual advice for you. If you really want to have more of a refined, advice, I would highly encourage you to meet with either Myra or some other financial advisor to kind of analyze your unique situation to ensure that you get the best advice for your unique situation. So I appreciate, before we start, because you got to make sure people understand that. But we do appreciate it. So Myra, one thing I would love you to do is if you could share a little bit about yourself, I think that'd be great.
Yes. So my name is Myra Sheene. I just got married in December, so it will be Myra Ryan very soon, but I'm a certified financial planner and CPA. I work at Align Wealth Management here in Louisville, Kentucky. I have over 13 years of tax experience and over 5 years experience as a licensed financial advisor. I work with a large team. We have a total of 18 financial advisors, and of the 18 advisors, 9 of us are CFPs and 2 of us are CPAs. And I want to brag a little bit on my CEO, Drew Watson, at my firm. He has repeatedly been chosen for the Barron's top 1,200 financial advisors and been voted Forbes Best in State Wealth Advisors. And first I want to talk about, I get a lot of questions of why did you choose to go from taxes, working as a CPA, to financial planning? So I made that decision because being a financial planner allows me to align my interests and build closer relationships with my clients. So as a financial planner, I have the opportunity to provide holistic advice and guidance to my clients, helping them make informed decisions about their finances.
That's awesome. Yeah. And you did mention that because obviously when we first met, and to give you some context, it's been about a year and change now since we've known each other, which is kind of crazy to think. But you did come from that CPA background and then got into financial planning, which is also provides unique context as far as, how do you do things in a very tax advantage way. And you understand that, from a tax standpoint and the implications of something like that, depending on what your unique situation is. So definitely do appreciate, your expertise in that front. So one thing I'm kind of curious about is, obviously a big contingent of our listeners operate in the brokerage space in commercial real estate. So, we're independent contractors, we kind of work for ourselves. We don't really have a salary. And we're kind of our own mini CEO, as they say. So a lot of times, I describe it as, you get in the transaction treadmill where you're, starting out in your career, you're probably not making a whole lot of money. I know my first year I made like $15,000. If it weren't for my draw, I would have made $15,000. So not a whole lot to really live off, but from when you start gaining a little bit of traction, you're still early in your career and trying to think about ways to be able to really make sure that you set yourself up for the future. What are some of the ways that you would kind of talk to a person in that position?
Yeah. So for young professionals, young independent contractors, there's a lot of advice I could give. And I know we're limited on time. So if we have time, I can elaborate more. But the biggest things that I think I would want the viewers to get from this podcast is the best method to save and invest for the future is to set up monthly automatic contributions to a Roth IRA or after-tax investments. There's a lot of benefits to that. It gives you flexibility. You're building your net worth without even think about it. So, and I know that income fluctuates. So, commission base. So what you have to do is, even if it's a small amount, even if it's $150 or $200, start getting the habit of putting something in, because anything is better than nothing. And then you're building the net worth in the right places and diversifying your assets. So that would probably be the biggest thing for young independent contractors. And another thing I want to touch base, because I'm a CPA, is 1099 people, you're no longer an employee if you're not a S Corp and you pay yourself wages. So it's very important to pay quarterly estimates. And people are like, oh, I'll just wait till I file my taxes, but there's penalties. So to avoid underpayment penalties, make quarterly estimated tax payments and make sure you work with the tax professional to make sure you have a system in place to know how much, and so you can plan for that. So the biggest things is start a retirement plan, preferably a Roth or an after-tax type of account. Start small, create your budget, pay yourself X amount. So, and don't live above your means. I think it's very important, being on commission, that you have to budget and pay yourself a fixed amount. And then any extras, then that's something you can decide what to do with the extras.
100%. No, that's some great advice. And I think, like you said, even if it's a little bit every month, setting aside something, because I fall victim to this too, is like, you look at your bank account, it's like, oh, that's how much money I have. But in reality, you got to factor in taxes, you got to factor in all these other things. And so removing some of the money from that account and putting it away somewhere where you don't have to look at it, I think it's psychologically, it's like, oh, okay, well, this is what I have to work with, even though it's not, you've got something already over on the other side. And I could speak to the tax side of things. I mean, luckily I've been pretty diligent about paying my quarterly taxes, because I've had friends out there that wait until the last minute, and then, come April 15th, it's like, oh, I got a $10,000 or $20,000 tax bill they got to pay all at once. And, if you haven't planned out for that, that could be pretty rough. So,
especially if you're newer to the business, it's a big surprise. And then you don't want to get behind, there's payment plans, but you don't want to get behind because the interest. And, but there is a rule of thumb. So if people, I usually say, if you get $1,000 in revenue, rule of thumb, hold back 30-40% for taxes. So if you're brand new to the business, work on, figuring out what structure, have a separate business account, because you don't want to mix that with your personal, because then that could be a big miss, a high risk to be audited. So you want to keep everything separate. And it's easier to manage, it's easier to identify, easier to handle, especially from the tax side. Oh, and I talked about a Roth, but I just want to make sure. So I get a lot of questions. What's a Roth versus a traditional IRA? There's Roth IRA, traditional IRA. So they're pretty much the same thing. They're both retirement accounts. The only difference is the way it's taxed. So traditional IRA, you're going to get the pre-tax deduction, if you're eligible. And then on the Roth, you don't get that pre-tax on the front end. But why I love Roths is it grows. They both grow tax deferred, but when you take the money out, it's all tax free from a Roth. So for young professionals, putting that money in now, having all that time to grow tax free, and then when the money comes out tax free, it provides such a good retirement plan for your future. And all the compounding interest. Right now, the market is down. Great opportunity to start investing. So, it's for the long term. So for retirement, to not get penalized, that age is 59 and a half. So people are like, well, when do I retire? 59 and a half is the age where you can pull money out of a retirement account and not pay any penalties. There are some exceptions, but 59 and a half is what you're looking at considered retirement age.
Definitely. No, I appreciate that. And it's important to know because, obviously we're in the real estate space. And so, I know a lot of people on the call and probably listening are also interested in investing in real estate, which is a great vehicle to build wealth, but it's also good to kind of think about ways to diversify and make sure that, you have those opportunities, and not to say you can't still use some of those funds down the line to potentially do other things as well. So, like you had mentioned. So one thing I'm curious about is, we also, kind of going up the train, the chain, as far as people who listen to the podcast. Now we're going into the more established professional, maybe you're 10 years or 15 years in your career, and now you're starting to make pretty significant money if you do perform at a high level for quite a period of time. And so because of that, tax implications are in play. Like, you have pretty significant tax implications. Are there ways outside of some of the ones that you maybe shared, or maybe with some of the ones you shared, and in addition to that could potentially be beneficial to those individuals?
Yes. So with, as the professional grows, I think it's very important to not only consider your retirement, but taxes. So normally as you grow and you get more income, it's important to look at the way you're structured. So very common, once your income exceeds a number, there's an option to form an S Corp. So that's where you can save money on that, on employment taxes. So the way a S Corp works is it's still a pass-through entity. You file a separate tax return, you'll get a K-1, so it'll flow through to you on your personal return, but you would pay yourself wages. So whatever you pay yourself wages, that would be subject to self-employment tax. So anything above that earnings, you can take a draw, but it's only going to be subject to federal and state tax, not Social Security, Medicare. So that is the really beneficial of the S Corp. The main reason is the self-employment tax savings. But if your income, you have to wait for your income to increase, because you have to factor in the cost of an S Corp tax return, the cost of paying wages, payroll. There's a lot of filings. It's kind of a pain. And if you try to do it yourself, I've seen it happen. People make mistakes, they forget to file, and then there's all these hefty penalties, and it's a big mess. So you don't want to get behind. So I'd highly recommend hiring a payroll service or account CPA firm to handle that for you. But that's one thing as you grow to think about forming an S Corp. But also from a retirement, there's simple strategies. So I'll start with the simple strategies. So it's all based on what you're trying to achieve. So the big thing I would think is you want to save for retirement. So when you do that, you're going to save in tax and provide you retirement income. So a lot of the basic retirement plans out there are simple IRAs, SEP IRAs, and 401k plans. So I'll start with the simple. So if someone doesn't have the funds, or they don't want to maximize their retirement, a simple IRA would allow you to contribute, and there is a max. So this year, a simple IRA max is $15,500. If you're over age 50, it's $19,000. So as an employer, if you have employees, there's a couple options. You would have to provide an employee match. So the good thing about the simple is there's no, you don't have to file a 5,500. You don't have to pay an annual fee to maintain it. You don't have to get a TPA involved. So it's very simple. Simple IRA is simple, but it only allows you to put in a little bit. So the next step up from a simple IRA is a SEP IRA. So SEP IRAs allow you to put in more. I believe the max is 66,000. So, but essentially whatever your net income, whatever your self-employment earnings, you're capped at about 25%. So if you make $100,000 that year, you can put in essentially 25,000. So it allows you to put in more than the simple, but you still have that cap based on your income. But I don't normally see people do that who have employees, because if you contribute 25% to your SEP IRA, you have to do the same to your employees. So it's very costly. So normally I see that for individual business owners with no employees. And now with the new Secure 2.0 Act, as of this year, they will be allowing simple and SEP IRAs to have a Roth component. So before you couldn't. So now you can have a Roth simple IRA and a Roth SEP IRA, which is going to be, very advantageous. And that's effective this year.
That's awesome.
So now we get to, okay, what about our super high income earners who want to maximize retirement and want to save on tax? So I'm talking, 300,000-400,000 plus income earners. They can look into doing a solo 401k plan. And there's group plans too, but for the high income earners, solo 401k or a 401k plan for the group. And then you can, to augment that, you can do profit sharing contributions. And in addition to that, a cash balance plan, which is a defined benefit plan. So in my opinion, those are the best choices of a retirement plan for high income earners who want to maximize retirement and want to save for taxes. Now, these are really complicated. So I highly encourage you to reach out to a professional such as myself or someone highly skilled in these areas. Because they are so complex. I see people sometimes trying to do it themselves and they get it wrong. So, based on your needs, you need to craft a creative strategy based on your needs. And plan the design around what your objectives are, estate planning, tax reduction, tax positioning, Roth 401k, and then a business transition. So there's not a one size fits all. But I'm just trying to tell people there are options out there. The cash balance plan, the max you can put in that is $265,000 a year, but there's limitations based on age, compensation of what you're eligible to contribute. But those two options would allow you to really put back money and save for retirement.
That's awesome. No, I appreciate the feedback, and in particular about the corporate structure regarding S Corp and everything else. I mean, I think that could be very beneficial, especially because, when you first start out, I mean, for me, I was an LLC and I was just taking in all the income myself. And, obviously, as you had mentioned, you're subject to self-employment tax and other factors as well that maybe aren't as advantageous. And as I started to advance, and now I'm in almost year 4, now I'm established as S Corp, and I pay myself as a wage, and you don't necessarily have to pay you have to pay yourself a market wage. You don't have to pay yourself like a significant amount, and then you could take, the draws that may not be subject to the self-employment tax. So that's definitely beneficial. And then I appreciate that you're sharing the feedback regarding those different instruments, because, I'm not the most advanced when it comes to that sort of thing. And so I'm always thinking of ways to potentially, invest or save in some tax advantage way. So I appreciate the feedback on that front. And one thing that you kind of alluded to was the business owner and team. So we have, again, in the brokerage career, the spectrum is you usually start out, you're not making a whole lot of money. And as you start to advance in your career, you continue to grow and scale. And hopefully at some point you gain, significant amount of income. And maybe at that point, you also decide, hey, instead of, me just being a solo individual, maybe now I want to grow a team. So you bring junior brokers under you. Maybe you have staff and admin and everything else there to support your business. So, when it comes to that, you kind of alluded to some of it already, but I'm kind of curious as to, what you've seen in the marketplace as far as, employers now providing opportunities to their teams for investing properly. And there's obviously reasons for that. I mean, you get to support your teammates, and potentially it's a good recruiting tool for you as well.
Oh, for sure. Because a lot of employers want to take care of their employees, because when you take care of your employees, those employees, it establishes loyalty. They will bend over backwards for you. It creates a good work environment, keeps them happy. So all around, you're supporting them in their future and showing that you care about them. So instead of, paying taxes on your income and it's going to taxes, putting money into the retirement, you're saving on taxes. So instead of paying it to the IRS, you're giving it to your employees. So very common is a 401k plan, a group 401k plan. And it's really an incentive right now is there's a lot of tax credits available. So the Secure 2.0 Act that came out this year, the IRS is saying, hey, for the next 3 years, we will pay the admin fee, 100% of any fees for 3 years, and up to $1,000 credit. You'll get a tax credit for every employee that you match, the employer match. We're going to give you a credit up to $1,000 per employee for 3 years. So right now it's a great time to open a 401k plan because of all the tax credits available. But in addition to that, a 401k plan, I don't think I mentioned this before, but the limits on a 401k plan for 2023 is $22,500 that an employee can contribute. Now, in addition, if you're 50 or older, you could put in 30,000. And there's different retirement plans, but the employer could potentially match if you do a safe harbor plan. So that would provide even more money. So that's where the employer would do a match, tax deductible, and that would help the employee, and it would help yourself. So, and then there's that profit sharing component. So you don't have to, just because you elect to have a profit sharing doesn't mean you have to every year. It's based on your profit. So at the end of the year, if you had a really good year, you can assess, does it make sense to do this profit sharing? And that's due when you file your taxes. So it's not due by 12/31.
So on the profit sharing side, that, because it's super intriguing, because obviously, you yourself, if you're a team lead and you have, brokers or agents under you, is that something you see where, I'm a business owner, I have a lot of independent contractors, and at the end of the year, if we do great, there's a profit sharing component to the independent contractors, or is it mainly for people who are on W-2 employees?
W-2 employees full time. So there's
Okay.
restrictions, 21 years or older. You have to work at least 1,000 hours. So that does provide your employees a way to save.
Sure.
But it all depends on how you build the plan. So it's very, very important. So when you get a third-party administrator, TPA involved, you have to design a plan, but you want to make sure you do it correctly, because with all the new tax laws, it's crucial, to provide yourself flexibility. So you got to develop it, and you got to factor in the design, make sure it provides tax diversification, and that it meets your needs as a business owner, because there's different tax buckets. So there's the pre-tax bucket, there's the Roth bucket, and then there's the taxable. And because different types of accounts and investments offer specific tax advantages, you can gain more control over your taxes by placing your investments in a variety of accounts. And taxation is just one consideration. So, if your income one year is going to be really high, had a big windfall, you had a great year, you're going to want to lean more towards the pre-tax option. But this year it's really slow. Like if COVID happened, you may want to do a Roth retirement account. So, being able to have that flexibility. So it's not always we're stuck with this. So you just want that flexibility.
No, I appreciate that. So kind of taking it to the next step. I mean, we do have a lot of people who listen who are interested in real estate investing, development of real estate and other methods, and so one thing I'm curious about is, are there ways to utilize these tax advantage accounts, or really whatever other methods to do so in a tax advantage way?
Yes. So one thing I want all the viewers to get from this question is there's when they are either buying or developing real estate, there's a lot of variables that go into that. And you have to factor in the assets being bought or developed. So so a big thing is cost segregation. I feel like a lot of tax preparers who are not experts in real estate, the rule of thumb, put 15% to land, 85% to the building. So as you know, from a tax, land, you cannot depreciate. So you can't get a deduction for the cost of land. A building, commercial buildings have a 39-year depreciation. So that's going to take, so you buy $1 million building, you can't fully expense it until after 39 years. So that's why it's so important to cost segregate your assets. So, if you buy a building, it has cabinets, ceiling fans, appliances, driveways, those all are eligible for bonus depreciation. So you can, last year bonus depreciation was 100%. So you could deduct the full cost of that year. So in 2023, that drops down to 80%. Next year, it's going to drop to 60% until it goes to nothing. So, segregating those assets, a driveway is a 15-year property. So you're able to accelerate that expense sooner by doing that. So it's very, very important to cost segregate. There's experts out there for a large purchase. I'd recommend hiring an engineer to come in and do that. Sometimes, a real estate CPA can do that, but I think that is a critical thing to think about. I see a lot of CPAs they don't specialize, they don't do that, and it ends up costing the taxpayer quite a bit in tax, or it's a missed opportunity.
Yeah, and especially because if you're a real estate professional, as classified by the IRS, you can offset the income that you generate through your commissions and other things with the taxes that the depreciation that you're taking from the building. If for some reason there's any, is that correct, or am I incorrect?
That is correct. So good point. So I call it the small landlord rule. So if you make below 100,000 a year, your rental, if you have a loss, you can deduct up to $25,000 towards earned income. So any income. So if you have W-2 earnings or whatever, that can reduce it. It starts to phase out between 100,000 and 150. So after you get over 150, you can't deduct it. So one time I had a tax client who bought all this real estate thinking he could deduct 100% of it. So you have to be aware that there is a limitation, and the most you can deduct in that year is the 25,000, if you have passive income. So if that's your intent to just make all this passive income, if you own real estate and get rent income, you can deduct a portion as long as your income is below that threshold.
That makes sense. So, and one last thing before we move on to the next topic, which I'm very interested by, and I think it could be very beneficial for people, is the, purchasing property. I guess, is there a way to purchase property in some of these accounts that could be beneficial? Like, I don't know, with the SEP IRA, is it only where you can invest in, stocks or bonds or anything like that?
You can invest in REITs, real estate investment companies that pull capital from investors, and it may be publicly traded or not. So there are options to buy REITs if you want to invest in real estate, but you don't want to physically manage the property. And I will say I'm not an expert in this, but there is something called a self-directed IRA. I just want to throw it out there. Again, I can't help you with that, but there is a thing that I think is common. It does allow you to, and you can invest in anything, I think, except for collectibles and something else, but you can invest real estate, crypto. So real estate, so if you have a property, you could invest that in your self-directed IRA. So if you have a 401k rollover, but again, I'm not an expert. I can't elaborate on that, but that is an option for people who are, there are specialists out there that can help with that.
Definitely. Well, I appreciate the feedback on that front. So one thing that I'm really curious about, and we actually had almost done this ourselves. I had a client that was looking to kind of perform this particular transaction. So let's say that, you're representing a client and they want to sell their real estate and they don't want to do a 1031 exchange because they're tired of managing property and they just want to, kind of ride off in the sunset and really benefit from that passive income. What are some of the strategies that you've seen people take on that could benefit that end user? So, I think we had tried to do this earlier this year, and unfortunately it just didn't fit what my client wanted, but it could be a very good opportunity for a lot of people. So
yes, so we had looked previously in a deferred sales trust. And I want to preface, this is highly specialized, highly skilled, but we're just going to kind of touch the surface on it. So what that does, if you don't want to do a 1031 exchange, is you take the proceeds, you can defer the gain, invest it, and never pay any tax on it. So that's very, that's, in some cases that's very attractive to, deferring that gain. No one wants to pay taxes. So it is a really good option to defer the gain, invest it, and grow that asset. And there are specialists out there because you have to have a very knowledgeable attorney. So you have to get an attorney involved. But that is an option but there are things to consider, such as, a big benefit of buying real estate and holding it until you die is your beneficiaries get that step up in basis. So if you bought a property for $30,000, 20 years later, you die, and now it's worth $200,000, your beneficiaries, if they go turn right around and sell it for $200,000, they're going to pay no income tax. They may have a loss because of the commission on it. So there's a lot of strategies before, when you die, you got to think of your beneficiaries. And that made me think of gifting. I see a lot of people who gift real estate. And I just want to say everyone's situation is different, but it's better to pass it through an inheritance when you die versus gifting, because once you gift, they take over your basis. So if you bought $30,000 for the property and you gifted that to your child, their basis is now $30,000. So if they turned right around and sold it for $200,000, they're going to have $170,000 capital gain that they have to pay income tax on. So you got to be aware and look at this, look at your goals. What are you trying to do? And sometimes it may make sense to gift it. But normally from a tax standpoint, it's better to, inherit property and versus gifting. But another thing also I wanted to touch base on that question is a Delaware statutory trust. So a Delaware statutory trust is for eligible investors. So you have to be accredited. What that means is you have to have income of at least $200,000, or with your spouse, $300,000, or you have to have a net worth over $1 million. So if you are accredited and eligible, you don't want to do a 1031 exchange, and you don't want to do actively managed property. So let's say someone's nearing retirement and they're like, hey, I don't want to pay the tax. I want to sell this property. I don't want to pay the tax on it. What can I do? Well, you can take the proceeds and invest into a REIT. So into a product that uses the 1031 code. But it doesn't involve actually buying the physical property. That is an option to save on tax. That's a Delaware statutory trust. So instead of buying a property or selling a property and buying a property, deferring the gain, you have to actively management. You can sell a property, use the proceeds to purchase a product. And the good thing about that, you defer the gain, you retain the ability to receive consistent income and provide diversification. So
Yep.
That's a very popular product out there. Highly skilled. I'm happy to talk to anyone who wants to dive deeper in that. And then there is another option, a qualified opportunity zone, a QOZ. It allows you to defer capital gain. Normally it needs to be a large amount, I'd say over 100,000 plus to make it worth the fees. But it does provide a tax incentive for economic development in distressed communities. So you can defer taxes on the gain from the sale of that asset. You have to invest it in a qualified opportunity zone within 100 days. And you can defer the tax until 2026 tax year. Now, the beauty of that, you're like, well, I'm only deferring tax for, 3 more years. What's so good about that? Well, any appreciation in that product, any appreciation, any gains, it'll grow tax deferred. And then if you hold it for at least 10 years, you'll never pay income tax on it. No tax on the appreciation. So you would pay income tax in 2026. So you get to defer it for a few years, but in 2026, pay the income tax on the original gain. But from there, any gain after that, as long as you hold it for 10 years, tax free. So that's also very attractive for people who don't want to have to actively manage. They want to defer gain and not have to physically manage a property. And then, from a tax standpoint, you sell a property and then you buy another property, you may be able to offset some of that gain through cost segregation. So that's where a good tax expert would come into play.
Absolutely. No, I appreciate you sharing that, because these are types of conversations that, I'm starting to have more with sellers, because a lot of times, when you're representing someone or attempting, let's say they're wanting to potentially sell their building, or maybe they're not, and they just say, hey, you know what, I don't really want to have to sell it because then I have to deal with potentially doing a 1031 exchange. And, then I have to, if I can't find a 1031 exchange replacement property, I'm either going to have to buy something I don't want or have to forfeit the exchange, thus having to pay the taxes. So I'm just not really wanting to deal with that. Whereas now it's like, okay, well, here is a suite of opportunities that could potentially fit what you're looking for. It may not be, exactly what you're looking for, and maybe it's not a good fit, but you're offering it up as an opportunity for someone, because again, everyone has their own unique situation, and maybe one of those options resonates with the seller. So if anything, you as a person, as a broker, for example, are providing a suite of options that potentially could win you business, so it's like, that's the way I'd like to view it, is because we're advisors, just like you're an advisor. So the more opportunities we can present, unique things for our clients to make better decisions for what they want to do ultimately, is only going to benefit our business long term. So
exactly. Yeah. Just letting them, knowing what their options, I think, is most important. Like, even because I have clients all the time, they just want to know their options and then help guide and walk them through what is your best option. Here, lay it all out there. What is the best? And I did want to mention, there's the traditional 1031. There is such a thing as a reverse 1031, where you buy it and then the proceeds go to an intermediary, and then in 45 days, you have to sell it, a property. So I thought that was kind of interesting. I'm not sure if a lot of people know about that, but I just want to make sure I put that out there.
No, I appreciate that. Yeah. And that could be a super powerful way, because then you can strategically buy the property that you actually want, as opposed to being under the gun, because that's the hardest part about 1031 exchanges. And especially in this environment where there's really not a lot of inventory, you're almost forced to at the end because you identify 3 properties and it's like, okay, well, I got to close on one of these 3 properties. And, you know, God forbid you go through those 3 properties and they're not a good fit. A lot of times you'll just see people pulling the trigger because they're like, I'm not having wanting to pay all this big tax bill. And then they have to live with the ramifications of making an investment that they may or may not have wanted to make. So.
Right. Right now it's a lot easier to sell than it is to buy. So.
Yeah. And it's starting to shift now too. So, you know, maybe the inventory improves over time, but then again, then you're selling in an environment where there's more inventory. So it's always an ebb and flow in the market. Right. So, but that's great. So what I'll go ahead and do is we'll open up to Q&A because we want to make sure that those who are listening, you know, here on Zoom, or if you guys are watching this on LinkedIn, you guys have an opportunity to ask Myra questions. Again, you know, she won't be able to be getting granular as far as your unique situation on the webinar, but if you guys wanted to have a conversation with her offline and have her, you know, dive into your whole, you know, back end and whatever else, then she'll be able to provide more refined insights. But if you guys have any questions, feel free to type away. And is there, in the meantime, is there anything that you wish that I would have asked, or maybe that you found to be, you know, potentially insightful for the audience that maybe you wish I would have asked?
And if some people are trying to gather their questions, you know, if they want to, you know, send those to you, Raphael, or they can send them directly to me, I'm happy to answer any questions if it pops up, let's say later today or tomorrow.
Oh yeah. Well, and the good thing about it too is that, you know, when we release these, because these are all recorded, you know, I include all, you know, the information of our speakers in the description as well. So, you know, those individuals who have unique questions, I'm sure, you know, I'm going to provide your email, and, you know, if you're open to it, you know, I can provide your professional phone number and everything, and they can just reach out to you. So Jesse has a question. Is it possible to defer taxes from the sale of real estate into an insurance product instead of Roth? So you mean like is that more so like infinite banking is what you're referencing? Okay. So I think you're referring to like a whole life policy.
Whole life. So he's saying sell real estate, investment property, and take the proceeds
and then fund a whole life product or something.
Is he wanting to know, to defer that tax? That I'll have to check on. I'll have to check on that one. Because I might have to be creative. But that one, I don't know if I've seen that, but I don't want to say it's not possible. So I will definitely get back to you, Jesse.
Yeah, and she will. She's gonna do her research for sure. So that's awesome. And Jesse, I know Jesse, he's local too. So we'll try to see if we can, you know, coordinate with you guys.
Awesome.
Any other questions? Myra, what are some of the best resources that people can learn about? I mean, I don't know if you guys have any personally, or if you have something that you like to refer to that maybe would be of benefit to the audience.
Well, we have a lot of great resources on our website you can go to. So the best thing to do is reach out to a professional that knows what they're doing. You know, especially for these advanced strategies, you know, it's really hard to do it yourself, and it does require a skilled professional. So if you you can Google my name, just type Myra Sheene, financial advisor, Louisville, Kentucky. I work at Align Wealth Management under an Ameriprise broker dealer. So that is probably there's so many resources out there available, but if there's anything, reach out to me if there's a specific question, but there's a lot of great resources on that website.
Yeah. So Michaela, I hope I said that right. I definitely don't want to butcher your name. I'm sorry. That was a lot of information that I would need later. I'm getting into real estate investing. Great. That's exciting.
Sure. Yeah, well, I'm happy to help guide you. And I know there's a lot of components So, being a certified financial planner, I look at more than just the investment management aspect. So, I work with my clients on, okay, retirement, budgeting, estate planning, taxes. So risk management, we didn't even touch that today. That would probably be another podcast, but protecting you and your loved ones. So I'll help my clients holistically. So Michaela, if that's something you just want to call me, I'm happy to help guide you through every step and just kind of get you moving in the right direction.
Definitely. Yeah. And you had mentioned it earlier in the podcast, but it's always important to reiterate, Myra's a CPA as well, which is, I mean, it's not super common that I've seen with a lot of financial planners is having that CPA background, because you do look from the tax standpoint. And I'm somewhat tax illiterate, to be quite honest. I rely pretty heavily on my CPA for most things. So definitely.
Yeah, it's very, very important. And being on both sides, I see how important things can get missed. So one thing that I do is all of my clients that I work with CPAs. So I have a third party consent. And so now our client has, and I like to include the attorneys too. So now when you have the attorney, the CPA, the financial advisor, all working for you, collaborating, it really provides a strong allegiance to help make sure your goals are aligned, because an attorney can make this beautiful trust, but if you don't incorporate the beneficiaries and follow the way the trust was intended, it was for nothing. And also for taxes, if the financial advisor is doing all this financial transactions that are causing either a tax ramification or not, that could be a surprise to the CPA. So you have to make sure all three of those professionals are communicating together on your behalf, or have them included in your meeting. When you meet with the CPA, have your financial advisor sit in on that meeting. So that's what I do, because that's true holistic planning.
Definitely. No, that's some great advice. So, well, we'll give it about a minute left for questions. So if you guys have any, feel free to type away. I'll check the LinkedIn messages as well. All right. Well, it looks like you've answered all the questions, Myra. Obviously we greatly appreciate your time. We know you're a busy professional, and we're looking forward to, hopefully people reaching out and inquiring about different things that may be beneficial for them in their business. As far as, people being able to get in touch with you, what are one of the best ways to be able to do that?
Well, the easiest thing is they can Google my name, Myra Ryan, or Myra Sheene. It will be changing to Ryan soon. View my websites, because they'll have access to my email, phone number, fax number. So whatever is convenient for you all is convenient for me. So if you prefer, I'm available for video chat, call, email. But that's probably the easiest way, is just to Google me, and all of my information is on the website.
Awesome. And we'll do what we'll do as well. We'll include a link to her page on Align Wealth Management, but I'll also include within there the email, phone number, and that and their information in the description as well. So if you guys are listening to this in a podcast format, it will be in the description. If you guys are watching this on YouTube, go ahead and check out below, and we'll be able to get you in touch. So Myra, again, thank you so much for your time. We do greatly appreciate it. Thank you all who are tuning in, both on LinkedIn and here on Zoom, and listen to this in a podcast format. We greatly appreciate all the support. We've had a significant uptick in our downloads. We're closing on 100,000 downloads, which is pretty crazy to think that that's actually been the case. And we have people tuning in from all across the nation. So do greatly appreciate it. Along with that, we do this every other week. So keep coming back, keep engaging with the group, and we'll talk to you guys soon.
All right. Thank you. Bye.
See you guys. Bye.